I know global uncertainty is at the top of everyone's mind, and yes, things are bad right now, but there's a lot of good going on too that we're not seeing if we're just watching the news or looking at our social media feeds. Fear is contagious, but so is hope. And yes, I'm a realtor, but I'm not sharing this information to promote buying or selling right now. I'm sharing this information to give a sense of understanding and hope for what's going on. I was an educator for 14 years prior to going into real estate, so that's really where my heart is. I love to educate and share information, and I know that there are so many questions that we don't have the answers to right now, and there's no doubt that we are in uncertain times. People are scared for their health, they're scared for their livelihoods, but as far as our economy goes, we can look at history somewhat to put things into perspective, which knowing all this really eases my fears about the state of our future, which is why I want to share this information with my friends. One of my most trusted resources for information is Keeping Current Matters. They're staffed with 25 researchers who provide relevant information without a political agenda. Their most recent webinar gave me a lot of insight and logical information that I really wanted to share and get this message out. So I'm going to go through the key takeaways here on this video. This is going to be long. The information to me is so valuable and shows the hope that I want to get out there, so I encourage you to like and share. I'll also try to make a few shorter videos with just chunks of info for those of you who don't get super excited over graphs and charts and data like I do, or maybe have a shorter attention span. But just putting it all together just kind of helps, see the big picture. So first, I have to preface this with I am not a financial expert or an attorney. I'm simply sharing information. I am not giving legal advice. So one of the questions before COVID-19 really started showing a presence here in our country was the drop in the stock market. And there are some people that were bailing out of the stock market, and I was getting the question, what does that do to housing? And really, it's kind of like we're in PTSD from 2008, from that housing crash. So when anything happens, people go back to that memory in fear, which I'll address that more as we go further into everything. So first, let's take a look at this slide right here. It shows the relationship between the 30-year mortgage rate and the 10-year treasury rate. So when we see money coming out of the stock market, what it's doing is it's flowing into the bond market. The U.S. Treasury is widely considered to be the safest investment in the world. When we look at the 10-year Treasury rate, it's what we look at to predict mortgage rates. Now this graph goes back 50 years to track the 30-year mortgage rate to the 10-year Treasury. And what was found and what we see here is this symbiotic relationship that the two move together in. And so while there's a lot of information out there, and I know that mortgage lenders are getting that question when the Federal Reserve lowers interest rates, what does that do to mortgage rates? Well, we know it doesn't have a direct correlation, but again, it does have a similar path. So the interesting thing is why we know that that's true, that changed last week. And it really changed to the extent that we have other forces in play in the market. As the 10-year Treasury rate has dropped, mortgage rates haven't followed. And there are a lot of people that talk about that, and now more than ever, it really is time to have a trusted advisor on your side that can give you great advice as a mortgage professional. But I want to highlight a quote real quick from First American to talk about that for just a second. As evidenced by recent events, often the spread increases because mortgage refinance application processing capacity cannot meet demand. So lender offered rates don't follow the treasury yield down 1-for-1. So lender offered rates don't follow the decline in response to the decline in yields to fall by the same magnitude as the treasury yield. So it's plausible that mortgage rates fall further if the benchmark 10-year treasury bond yield declines further. It's reasonable to expect that rates fall even further and likely surpass the prior record low, but just not necessarily 1-for-1 with the 10-year Treasury yield. Again, that was from Deputy Chief Economist Odetta Kushi from First American. But let's look at that over last year from the rate environment. Here's another graph, and it's showing the 30-year fixed mortgage rate from June 2018 up until the last week. And we know that this is volatile, and it's not meant to be an indicator of where rates are at. I actually know that they're up more than that, but this is really just to show the flow going forward in the volatility that we're seeing in a lot of things in the market that are different than we've ever seen. But know that going forward that we should be able to look at the 10-year Treasury as we look out into the future. And truly, interest rates from a historic point are still low. So people are still getting a great rate, but maybe not that unbelievable rate, that 2.9% that we saw just a few weeks ago. And the reason the interest rates came down so much is that the stock market had two of the worst weeks that it ever had. So again, the question, when the stock market goes down as quickly as it is, doesn't that have an effect on housing prices? So, just again, back to that question, will this be like 2008 all over again? So here are a couple more visuals to really help see what's going on. In this graph comes from the housing and mortgage crash of 2008 to the S&P correction at the same time. And when we look at that, what we see is the S&P correction 51% over that span of time. Then we see home prices depreciating just under 20% during that same time. And this is really like scar tissue. When we hear slow time or we see the stock market reacting, we think, gosh, are we going to see home prices depreciate? So let's put this in perspective. Here's a quote from economist Dave Rosenberg. And what it shows is there is a lot more in common with 9/11 than there is with 2008 when we start to look at these crises we faced. What 9/11 has in common with what is happening today is that this shock has also generated fear, angst, and anxiety among the general public. People avoided crowds then as they believed another terrorist attack was coming and are acting the same today to avoid getting sick. The same parts of the economy are under pressure: airlines, leisure, hospitality, restaurants, entertainment, consumer discretionary services in general. I know that we've all looked at this and understand that there are people being impacted very hard. My heart truly goes out to those people adversely affected, both those that are in fear of losing their livelihood or have lost their livelihood right now, and those brave men and women who are, putting themselves out in harm's way to keep our country going. But looking at this from happening from an event makes this much more like 9/11 than like 2008. This graph shows the dot-com crash and 9/11 and looked at housing as well. So when we look, we can see that the S&P correction, and we can also see the housing market. The S&P correction you see there was at 45%. But then we know cumulatively over that same time, housing appreciated almost 24%. So very different the way housing reacted at 9/11 in the dot-com crash versus what housing did in 2008. So that is one thing that I really want you to see in today's environment, because a picture is worth 1,000 words. So really see this. This basically, what this shows very visually is, if this time that we are in is a lot more like 9/11 than it is like 2008, then the housing market is a lot more likely to react like it did after 9/11 and the dot-com crash than it did like the 2008 crash. So what we can see here, friends, is the annual home price appreciation versus the stock market reacted very well during those times. And as far as housing goes, there was a tremendous start to the year. The existing home porch report just came out and showed we had the highest amount of homes sold in the past 13 years on an annual adjusted basis. So with everything that's going on now, we know that those numbers are going to go down, right? Now we're forced to slow or shelter in place. So when this is over, and it will someday be over, when that time comes, I really think that everything is going to come roaring back. So these numbers are not unreasonable to expect to take place, even though we're in a stock market situation. Now, there are serious worries about our economy and if we're headed into another recession. And what does that mean? We've talked about the likelihood of a recession, expecting it in the future, just in a different way. But the reality today is we can all see the slowdown. We can feel it. We can see it in our Oklahoma towns that are asking businesses to close, seeing it in the sheltering in place, the other states doing the same. We know that this is and is going to continue to have an impact on economic activity. So the interesting thing is when we talk about the recession, when we talk about this, a recession is a slowdown in economic activity. When we hear and think about a recession, we all have these immediate fears and thoughts about what the prior recession was. And that's really just the reality of the world we live in. Now, if we talk about an economic slowdown, that's very different, and it's critical to keep that in mind. Let's again look at what the experts are saying. Here's a quote from Bill McBride with Calculated Risk. With a sudden economic stop and with many states shutting down by closing down schools, bars, and restaurants, my view is the U.S. economy is now in a recession, started in March 2020, and GDP will decline sharply in Q2 as Goldman Sachs is forecasting. The length of the recession will depend on the course of the pandemic. So what is Bill saying there? Certainly we're seeing that and we're feeling that economically right now. We're feeling a slowdown. We can see that it's going to go on through the course of this pandemic. So, using analogy to show 2008 to where we are today, 2008 was more like a tornado, came through the country and ripped apart buildings, ripped up phone and electric lines that had to be slowly rebuilt over time. And an analogy with what we're experiencing today is more like a heavy, heavy snowstorm. It's shutting things down. But what we know is that as time goes on, that snowstorm is going to let up and things will reopen. The courthouses will reopen, restaurants and bars will reopen, and we'll be able to go to concerts and sports games. And really the biggest thing will be, can we get tickets to those games and seats at restaurants? Because everyone is going to want to go out there and do that. People are going to want to get out of their home and go and have a nice dinner, go out and have drinks with friends. Graphically speaking, Goldman Sachs starts to show this V of a recovery versus a U like what we saw in 2008. A sharp decline with a further sharp increase going into 2021. So looking again towards the experts, Wells Fargo agrees as well, as you can see in this quote. We do not expect a repeat of the severe recession of 2008-2009. Because the virus and oil shocks are not endemic to the financial system but are rather external. Once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of the year and especially into 2021. And let's just look at this again. I've posted it on previous market updates because this is just such an important visual. But looking back at the last 5 recessions, going back to 1980, what we know is that 3 of those last 5 recessions, home prices actually increased. In one recession back in 1991, we saw a 1.9% decrease. But what we remember is 2008 when we saw a significant decrease of almost 20%. And I do feel like that this is so important to get out there, that a recession does not equal a housing crisis. A recession is an economic slowdown over 2 consecutive quarters. We can see it right now. We can see things closing down. It makes a lot of sense that we would be going into a recession. Now again, let's talk about 2008, because 2008 devastated our economy and our country. Families were having to leave their houses and tell their kids that they can no longer be in their homes. There was a lot of hurt and tears. But we do need to compare what is happening today, because there are some currents that are similar to 2008. So let's talk about this. Okay. Look at this announcement from the FHA. The Federal Housing Administration indicated it is enacting immediate foreclosure and eviction moratorium for single-family homeowners with FHA-insured mortgages for the next 60 days. The Federal Housing Finance Agency announced it is directing Fannie Mae and Freddie Mac to suspend foreclosures and evictions for at least 60 days. So what are we seeing right now? What are we seeing here? We're seeing things that in 2008 we got wrong. You're seeing government respond to the needs of the needs that people have. So we can say, how do we not have that happen again? There's a lot more to be written as far as the banks go to carry everything out. But action like this that we're starting to look at, that is very different than what we saw in 2008. And there are structural differences in the processes too that are very different than 2008. Okay, let's hop on to a couple more slides here. So let's think about where we were in 2008. And back in that time, you can see here, look at this, 824 billion. That is billion with a B of cash out refinances. And people were largely using their homes as an ATM machine. Really taking cash out, harvesting the equity from their home, and a lot of times putting that into depreciating assets. But when we start to look at today, in the past 3 years, we can see that cash out refinances are really a fraction of what they were heading up to 2008, with a total of only 232 billion. That's nearly 3/4 less than what we saw leading up to 2008. So really, the underlying story there is that the country, learned their lesson, and people are not doing what they did in the past with the equity in their homes. We know today that the equity position across the country is very different than it was in 2008. We know over 50% of the homes in this country have over 50% equity. People aren't walking away from that. In 2008, people started walking away from their homes when they had a negative equity, when they were in situations where they owed more than their homes were worth. We are in a very, very different situation in this country today than we were then. Okay, now let's take a look at another aspect. Let's talk about income for just a second. Look at this slide. As we started out this year, we were seeing a market where income was rising and mortgage rates were falling. And what that created is a drop. Historically, 21.2% of someone's income would be dedicated to their mortgage. And right now what we're seeing leading into this was that number dropped to 14.8%, which is significantly lower than the historic norm, speaking specifically to the leverage of the consumer, relative to housing. So there are definitely several positives with the structure of our economy right now that will help us in our country going through this together. I would strongly encourage everyone to support local small business. I would love to feature your small business on a Zoom call to where we could highlight your business and we can talk about how we can still do business in the midst of social distancing or sheltering in place. This is a scary time, but fear doesn't change the outcome. We have to pull together. We have to embrace and get through this. What is happening now in our world, and we know that we will get through this and we will come out stronger. I also understand that there's some people who are in a position to where they have to sell or buy right now, or they can't or don't want to wait on the sidelines. If that is the case and you want to talk through some options, please feel free to call, text, or message me. I hope that you got some valuable information from this. Let's pull together, enjoy your family time. I remember the 2-week ice storm years and years ago is one of my favorite memories that I cherish with my family. So although that we're all going through this and it's very hard, we're going to look back on this and there are going to be, some very good memories too. So I hope this helped. Support local small business and have a great day.